when I stumble across an article that says AMC buy to covers are driving the stock up, I can't not share it with you guys. So that's what we are going to do here in this video, is look over this article, what they are saying, if the data reflects that, and if the data reflects that, where potentially could AMC stock be going based off of that said data, guys. So let's get straight into this video. Hit that like button and subscribe to the channel if you have not already. It's free 99. Inflationary pressures have not hit it as far as yet. Now, let's talk about it, guys. So AMC buy to covers are driving the stock up. Okay. AMC shares have seen an impressive rally after the company reported Q3 earnings. Here's what's behind the share price increase. And it says on November 8th, AMC reported an all-around beat on Q3 earnings, and AMC shares rallied more than 50% in the following days. AMC is expecting an even better fourth quarter with the release of blockbusters Black Panther and Wakanda Forever and Avatar 2. The latest AMC surge also stems from short sellers being faced to hedge their positions at very high borrow fees. And this is the better than expected quarter. Long story short, revenue came in at $968 million versus expectations of $961 million. The company reported hosting more than 53 million moviegoers in the third quarter, which is a year-over-year increase of 33%. However, the movie theater chain also reported wider net losses than in the same period last year. AMC had a loss per share of 20 cents versus an expected loss of 24 cents. AMC also reported that it has about $900 million of liquidity, which provides it with some strength to move forward its goals of both growing and financing its operations. It will also help keep AMC out of bankruptcy for the near term. Although the quarter wasn't the best AMC has ever had, and it's still failing to meet pre-pandemic levels, the company could have been worse considering industry headwinds. And essentially, the long story short of earnings, and the thing, or really the reason why the markets looked at earnings so bullishly, in my personal opinion, was because there was just a lack of movies. There wasn't really a big reason to go to theaters, and AMC still put up very good numbers, relatively speaking, right? They pretty much beat across the board. With this next quarter and the quarter after that, and basically all throughout 2023, you're expecting to get more blockbuster movies that are heading to theaters than what we've seen in 2022. And people are going to those theaters to watch movies when there is quality big movies that some are sequels, some are brand new, right? Black Panther, we already knew the first one was good. Second one turning out to be probably better than the first one. Avatar, that movie came out I think in 2009. It's the single biggest blockbuster movie of all time. There's no bigger than the original Avatar, and the sequel comes out in December. So for a lot of reasons, the markets are bullish, and it's really justifiably so. I think there should have been a 50% rally after what we got out of earnings. Now, let's take a look at this. It says lots of buy to covers. It's no news that AMC has been able to survive the COVID-19 pandemic thanks to retail investors who came together to squeeze the short sellers who were betting on the company's downfall. This quote, meme stock mania caused by a big spike in AMC's share price, enough so that the company was able to raise over $1 billion in cash by issuing more shares, which helped keep the company's liquidity in shape. According to AMC's CEO, if retail investors hadn't been there, we wouldn't be here today. The truth is, even more than 18 months after meme investors adopted AMC shares, remain highly vulnerable to short squeezes. This is because there continues to be a lot of short sellers betting against the stock. According to the most recent data, AMC short interest stands at over $500 million, and nearly 20% of its total float is being shorted. AMC's popularity among short sellers is even more noticeable when you look at the borrow fees that are required to short the stock. Driven by short interest supply and demand during October, fees remain between 18%. After the third quarter's earnings release, AMC's borrow fees jumped to over 100%. At these levels, volatility in the stock is certainly due to buy to covers. Now, when we actually look at what was, bought to essentially cover in AMC, you really haven't seen much of a move down in the short interest, not the official reports, not the live short interest, and actually for the official reports, the short interest has been staying relatively the same at about 20% for a while now. So you're not seeing that reflected in the official reports as of right now. We do want to watch here shortly. We will be getting new updated numbers, but that's still probably for another week and a half to 2 weeks from now. Now, as far as the live short interest, that's at the 20.12%. The highest I have seen the live short interest throughout all of this rally was about 20.5%. So if 0.4% out of 20% was actually covered and you got a 50% rally, that's 2.5% of the float that was covered that sold short, and you got a 50% rally. 2.5%. That is it. So if you extrapolate those numbers, you could go very high here with AMC stock. And when we actually look at AMC on a more technical basis, it looks beautiful, guys. Like, the rally is holding together, and from my point of view here, it almost looks like AMC is just trying to hold a bullish pattern, a bullish technical chart, until the markets turn around a little bit and give us a favorable market condition to really rally. And maybe some more numbers from Black Panther might be what we need to get the stock to move a little bit higher, or maybe some new announcement from the company. Nonetheless, what we're seeing right now is very encouraging. And let me just remind you, a 2.5% covering out of the 20% short interest that we have caused a 50% rally in the stock. And a big reason why this is actually happening is because the days to cover are just so high. I mean, when you actually look at days to cover, you're sitting at almost 6. So when shorts want to get out, let's call it 1 million shares or 500,000 shares, it's not so easy to actually do that. And at the same time, it is driving up the cost to borrow rates, and a lot of cost to borrow rates are not fixed. It's not like a mortgage, guys. We're not dealing with 30-year houses that you could, or mortgages that are on houses that you could literally live in. You could walk inside of these assets. You're dealing with stocks, very risky stocks in 2022. Everything's risky. Doesn't matter what it is. So a lot of these are adjustable rates, right? And when you're seeing 50% cost to borrow rates for the live short interest, or right now what we're seeing today, 50%, well, that's putting a lot of pressure on those said hedge funds, and that can definitely help to squeeze out more shorts the further we get into this situation, guys. So as long as the chart remains bullish and the data remains bullish, I will also remain bullish. When this situation changes, for the better, for the worse, I will let you guys know exactly what is happening. So with that being said, that is basically it for this video, but I do want to go over this brief article with you guys as well that came out about two days ago from the New York Fed, and it's about household debt. So household debt climbed $16.5 trillion, and why I think this is incredible is because the numbers here are large and they are going up very fast. So it says, new data from the Federal Reserve Bank of New York shows American household debt continuing to climb, with credit card balances jumping at their highest rate in 2 decades. According to the quarterly report on household debt and credit by the Fed's Center of Macroeconomic Data, household debt for the third quarter of 2022 rose 2.2%, or, get this, $351 billion to reach $16.51 trillion. Meanwhile, the report showed credit card balances rising by $38 billion, a 15% year-over-year increase. That is the largest in more than, get this, 20 years. Mortgage balances increased by $282 billion in the third quarter to reach $11.67 trillion at the end of September, marking a $1 trillion increase from last year. And that doesn't surprise me all too much. There's a lot of debt in houses, but households overall are in very good shapes with their mortgages, right? A lot of people are not underwater on their mortgages unless you just recently bought a house and you drastically overpaid for it. But the credit cards, oh my gosh, $38 billion increase, 15% year-over-year increase. That is the largest in 20 years. That's a problem, and I think that will continue to be a problem in 2023. And that's something that can definitely help fuel a recession. When people get that leveraged and are taking out that much debt. You know, there was a statistic and really another article that came out today talking about how 60% of Americans heading into the holiday season are living paycheck to paycheck. At that point, it doesn't take a lot for defaults to actually start happening, especially around this time of the year, guys. So some interesting facts I did want to share with you guys. I don't know how it's going to affect the markets in the short term, but in the long term, this can definitely have huge implications. So you definitely want to pay attention to this. And if you guys want to stay up to date with everything going on in the markets, with AMC, with our favorite stocks, with any stock that has good potential, hit that like button and subscribe to the channel. That is how you can do so. And if you guys want to come trade with me live in real time as well, link down below in the description of this video. You guys, most importantly, enjoy the rest of your day, and I will see you in the next one.